So first, I'd like to thank the Washington Insurance Climate Summit for having me speak today. My name is Yoon Kim, and I lead client service for Moody's ESG Solutions. And so first, by way of introduction to Moody's ESG Solutions, we are part of the broader Moody's umbrella, and Moody's ESG Solutions was established with the goal of bringing deep domain expertise in both ESG and climate risk to the market. And so Moody's did this through acquisitions in North America in 427 and in Europe in a company called VE to launch Moody's ESG Solutions Group. We focus on ESG and climate-related measures, as well as sustainable finance and benchmarks, which are also integrated with Moody's Analytics, risk management solutions, and Moody's Investor Services credit ratings. So we live under the Moody's umbrella in parallel to the Investor Service, which is the credit rating portion of the agency, and Moody's Analytics. In terms of what I will speak to today, so I'll provide an overview of key market drivers and trends that are behind increased interest in climate risk assessment and disclosure, as well as speak to data to help support evaluation of climate risks. When it comes to market drivers and trends, we're seeing increased economic costs with climate change. For example, in 2020, climate-related weather events caused $268 billion of global economic damage, of which 64%, almost two-thirds of this amount, were uninsured. In addition to this, we're seeing increased regulatory pressure as regulators recognize the systemic threat that climate risks pose. And highlights of this landscape include disclosure requirements, typically aligned with TCFD guidance. Europe is leading the way on this front, but we're also seeing regulators in China, New Zealand, and other geographies implement similar requirements. There's also been a push to incorporate climate risk into risk management and supervision, from credit origination to capital requirements. And once again, Europe is leading the way on this front, but we're also seeing countries in other geographies take this on, and in particular, many of the members of the Network for Greening the Financial System. And it's really central banks in many ways who have been taking the lead on this front and establishing good practices for disclosures, risk management, green finance, and integration into monetary policy. And so, for instance, the Bank of England evaluated their portfolio's exposure to climate risks in an award-winning disclosure report. And investors, in addition to what we're seeing on the regulatory front, investors are also increasingly expecting assessment and disclosures of climate risks and demonstrated efforts to reduce greenhouse gas emissions. And so notably, Larry Fink, in his 2021 letter to CEOs, clearly underscores the fact that climate risk is investment risk. And we're seeing this type of perspective being adopted by more and more investors. Lastly, investors, banks, and corporations are also committing to ambitious emissions reductions. For example, the Net Zero Carbon Asset Owner Alliance, which includes 33 such investors with assets worth more than $4.5 trillion, are actively seeking to implement ambitious emissions cuts. In terms of U.S. regulatory development, so even in the U.S., which has tended to lag Europe on, for instance, climate risk assessment requirements, we're seeing important activity at the state level and increasingly expecting to see federal action. So, and the types of actions that we've seen fall under four broad umbrellas. The first is understanding exposure of insurers' climate risks. And this has entailed efforts, for instance, by the National Association of Insurance Commissioners, their Climate Risk Disclosure Survey, which explores a range of climate-related issues, including mitigation, emissions and carbon footprints, financial solvency and investment. And then at the state level, the California Department of Insurance has implemented a set of more detailed surveys exploring insurers' exposure to fossil fuel invested assets. Secondly, there are increasingly calls to develop climate risk exposure management guidelines. While criteria for consideration of these climate risks have not yet been explicitly established, expectations are such that insurers manage all material risks. Their management of these risks implicitly entails coverage of climate risks. Furthermore, it's expected that the NAICS Climate and Resiliency Task Force's work will likely ultimately result in additional guidance for insurers. Third, stress tests to identify exposure and improve response. Although US insurers and regulators have a very good understanding of how to assess, manage, deal with natural catastrophes, stress tests and scenario analysis focus specifically on climate change risks, so taking account of the forward-looking risks we can expect with climate change. This is not yet widespread. Certain regulators are more advanced than others in this regard. For instance, the California Department of Insurance evaluated the exposure of California insurers' portfolios to transition risks, looking at over $4 trillion in investments. And then the last piece is more rigorous climate disclosure requirements. Publicly listed entities disclose climate risk as part of their general requirement to report relevant material risks. However, it's also expected that the SEC will ultimately move toward more specific requirements regarding climate risk disclosure. On the investor front, some of the drivers that we see underpinning their interest include the fact that asset owners, they have long-term liabilities that incentivize them to take a long-term view of risk. So for instance, large asset owners such as pension funds are forced to take a longer-term view because they have long-term liabilities as they intend to pay out retirements for the next 100 years, for instance. Asset owners are also increasingly requiring asset managers to account for climate risks. And recent legal opinions and regulatory guidelines have emphasized that fiduciary duty encompasses consideration of climate risks. So although this type of perspective has not been taken up extensively in the US and other countries such as Canada, the UK, and Sweden, they're taking steps to redefine this fiduciary duty concept. And then lastly, we're seeing more mainstreaming of climate considerations throughout investment firms. So climate is no longer siloed within the context of an ESG or sustainability focused group, and no longer just talked about, let's say, at senior or C-suite levels, but is really being incorporated into the work of portfolio managers and analysts. So when it comes to assessing physical and transition risks, there are a number of risks and opportunities it's useful to keep in mind for the insurance sector. And so first, in order to define physical risks and transition risks, physical risks relate to the impacts that we're experiencing because of a changing climate. And that includes both acute events as well as chronic. The acute events are those that basically extreme events, wildfires, floods, hurricanes, and so on, all of which basically we're experiencing currently in the US, more or less. And the chronic events are the slower, longer-term onset, longer-term impacts related to things like sea level rise and temperature increase. Transition risks are risks that are associated with as we shift away from a fossil fuel-based economy. And so when it comes to physical risks, the types of impacts that this could have on the insurance industry include things like increased claims for weather-related hazards, which could potentially require adjustment of risk assessment frameworks and inclusion of forward-looking data. So one of the key things to keep in mind is that when it comes to climate change, the CAT models are likely not going to do justice to the types of impacts that we'll experience with climate change because of their historical perspective. And so really critical to take this intentional forward-looking view and incorporate forward-looking data. Increased costs for reinsurance, for instance, as tail events become more common and severe. The affordability of insuring some areas may decrease premiums and profits. And then the rapid repricing of assets that are exposed to climate risks may have negative implications for investment portfolios. In addition to these risks, there are likely to be some opportunities on the physical risk side that may include being able to explore new markets that face hazards that have not been previously experienced and thus require new insurance offerings. On the transition risk side, with the transition away from a fossil fuel-based economy, there may be decreased feasibility of certain lines of business that cater to carbon-intensive industries. Higher litigation risks stemming from the uncertainty that's associated with an evolving regulatory landscape. Reputational impacts for insurers that continue to provide services to carbon-intensive industries as more of the world makes that shift and customer expectations change. And then businesses focused on renewable energy and other technological advancements, they potentially present a new underwriting and investment opportunities. So once again, on the transition risk side, there are opportunities in addition to the risks that they pose, that those climate risks pose. And then as far as an approach to evaluating climate risk, where we typically see our clients start is with education and awareness. So really working with internal stakeholders to socialize the impact of climate risk on financial risk and just make sure people have a baseline understanding of, yes, this is an important and relevant set of factors for the work that I do. Risk identification then is the next step and entails the identification of both physical and transition risk exposure. So better understanding what specifically is at risk and what risks are my assets subject to. Then in order to be able to quantify risk, leveraging tools like climate pathway scenarios in order to enable assessment of the impact on balance sheets from physical and transition risks, and then leveraging all the results of all this ultimately to be able to report in alignment with regulatory and TCFD requirements. And so different data inputs are required at each stage. And at the risk identification stage, for instance, you need asset-specific physical and transition risk data, as well as climate governance data that helps you not only to understand what, let's say, a company is exposed to, but how they're managing these risks and how well positioned they are to manage these going forward. On the physical risk side, there are a number of different levels at which analysis can be conducted. When it comes to real estate and real asset exposure, ideally you want to look at exposure at a very granular level. So at a level that is asset specific and enables you to differentiate, for instance, flood and sea level rise exposure, parcel to parcel, even within high risk geographies. And so I'm highlighting a snapshot here from our Climate on Demand application, but you can see that it's helpful to understand not only which hazards is your site exposed to, but what are the specific, for instance, underlying factors that are helping to drive that change for each hazard. And then at the company level, it's useful to understand not only operations risk based on your facility footprint, but also what does supply chain risk look like? What does market risk look like from a climate perspective? And really gaining that overall view of a company's exposure so that one understands not just what's operationally relevant, but also where there might be potential implications for, let's say, countries that have resource-intensive supply chains or that have markets that are highly exposed to critical weather hazards. On the market piece, you can layer these to understand what, from a market perspective, which markets are at greater risk for a given insurer. And so you can evaluate, for instance, the exposure of a set of companies based on their locations to a set of key climate hazards. Or you can leverage something like our sub-sovereign scores, for instance, which evaluate exposure to climate risks at a very granular level, at the state level, county level, city level, zip code, so that you can really differentiate risk within that context as well and understand where some of your risk hotspots might be. From a physical risk management perspective, as mentioned, in addition to being able to understand that a company is exposed to climate hazards and identifying what specifically they're exposed to, ideally you want a sense of how are companies managing these risks. So what's the impact on their corporate assets? What are the potential increased costs, supply chain disruptions, operational disruptions, and how well positioned is a company to anticipate, prevent, and manage these types of impacts. On the transition risk side for commercial real estate, it's important to understand not only building level performance now, so what is their energy and carbon footprint, but how well positioned, what's the potential trajectory as we start to look at changing policies, for instance. So if we know that a certain jurisdiction has policies associated with mitigation targets, how does this particular building align with that? What types of implementation measure, what types of measures can you put in place in order to move in that direction? So in addition to, for instance, portfolio-wide energy and carbon performance assessments, being able to simulate transition risk mitigation pathways, and then estimate renovation costs so that you can meet your carbon reduction targets. At the transition risk level for companies, it's important not only to understand carbon footprints for scopes 1, 2, and 3, but also how well positioned how exposed they are from an energy transition perspective generally. So how well do they do when it comes to green products and services? What about transportation? What does their energy consumption look like? Their use and disposal of products? And understanding these elements, as well as where leadership lands, how they implement, what are their results, in order to get a view on their overall energy transition positioning is critically important. And so with that, I will wrap up. I have included my contact details on this last slide, and you are all more than welcome to reach out to me should you have any questions, and I look forward to hopefully continuing to engage with you.